Hello everyone, it's Kaibe here. So this is going to be our second lesson on the LE model. And please, we have already done a video for the first lesson. So if you have not watched it, please make sure to check it out. And from our data, we have seen that about 90% of those who watch our videos have not subscribed to the channel yet. So to help us grow, please click the like button and also subscribe to the channel to help us improve our trading content. Okay, so the last time we talked about the first LE model, which is also known as the ABC model. And I said with an uptrend, we have an impulsive move, or let's say price starts with a low, and then we have a retracement. Price will form a turning point. Price comes and take out the structural liquidity or the inducement, and then continues with the upwards direction. It's the same for a downtrend. With a downtrend, we have a high here. Price will move downwards. Price will form a retracement, or it will bring what a structural liquidity on inducement. It will then move downwards to form a break of structure. After the break of structure has happened, price will then move up, take out the structural liquidity or the inducement. That's where people will be placing their stop losses, trigger all the latent orders or the stop losses, and then it continues with the downwards direction. Continues with the downward direction. Okay, so with our first lesson, I also said the A level, that's in the case of an uptrend or a downtrend, must always be in confluence with what? Support and resistance levels, supply and demand levels, QMR, and also sweeps of higher time frames, highs and lows. I talked about that in our previous lesson. So sweeps of higher time frame highs or lows. Either we have a high taking or we have a low taking, and then we have supply and demand. Supply and demand. We have support and resistance. Support and resistance, and then we have the QMR zone. So if the A level has a low or the high in the case of an uptrend or a downtrend respectively, it's in confluence with any of these four zones, areas or levels, and it makes the trade a very, very, very highly probable trade. You always end up taking what? A winning trade. Always end up taking a winning trade. And you just don't trade the model like that. It is not a pattern. You just don't trade it as that. You always have to verify your structures, especially the structural liquidity. So today our lesson is basically going to be on how to verify the B level or the structural liquidity or the inducement, and also how to enter. And I'll be showing you examples on all of these pairs, both for an uptrend and then a downtrend. So how to enter a trade using the ABC model. This is a very simple strategy. Trading must not be really complex for anybody. If you have a strategy on an edge, you always have your psychology around the strategy that you trade, and you know by the end of the month, if you're doing everything right, you're going to end up profitable. So how do we verify the B level, and also how do we enter? Okay, so with an uptrend, okay, so we have a low, we have a structural liquidity, and then price will move upwards to what form the turning point. So here is our A level, this is our B level, this is our B, and that is our C. But to always take a trade, we always need to first verify our structural liquidity. How do we verify? We use the Fibonacci 2, and this is my settings for my Fibonacci 2. So if you want to use my settings, you can take a screenshot. Okay, so now let's verify our structural liquidity. How do we verify our structural liquidity? We mark our Fibonacci 2 from the low. In the case of an uptrend here, we are marking from the A level to where we have the breakout structure. So if the B level is on the 50% retracement level or below it, but if it is way above, then it's not valid. The structural liquidity must be on the 50% retracement level. It must also be below it or a little close to the A level before we can say this structural liquidity is valid. But in the case if you have the structural liquidity way above the 50% level or on a 38% level, then the structural liquidity is not valid. So this is that for an uptrend. This is that for an uptrend. Forgive me. So for an uptrend, this is how it is. And for a downtrend, it is the same process. It is the same process for a downtrend. So with a downtrend, we have what? A high, we have a structural liquidity or the retracement that form the structural liquidity. We have a breakout structure. Then we expect the market to come or take out B level before we enter the trade. But we always need to verify our structural liquidity. If the B level or the inducement is not valid and you take the trade, you might end up taking what? A loss. So it is always best to verify your structural liquidity before taking a trade. So here you mark your Fibonacci from the high to where we have the breakout structure. So if the structural liquidity or the B level is, in this case, it is on what? If it can be on the 50% retracement level or above it, then it is valid. But if it is on the 38% level, in that case, it is what? It is not valid. It is not valid. Even if it's on the 61.8% level, the structural liquidity is still valid. So how to verify the B level? That's very, very simple for the ABC model. But let's also talk about how do you actually enter a trade. And after this, I'm going to show you examples of trades I've taken with what? This strategy. And this is the only strategy that I trade as a method. So how to enter a trade using the ABC model. So same thing applies to this one. For an uptrend, so in the case if you spot our pattern in an uptrend, this is how we are going to verify it. And the same applies to downtrend. This is how we are going to enter the trade. So with an uptrend, we have a low structural liquidity, price reward, form a breakout structure. How do we enter the trade? So here, note something, don't get confused here. So mark your Fibonacci 2 from the low to where we have the structural liquidity. So you mark it from this low to the low of the structural liquidity. That's between this range from here to here. And then we're going to use any of these three levels in the middle. That's 38.2% level, the 50% level, and the 61.8% level for entry. So you can either stick to the 50% level or the 38.2% level for entry. So this is what happens here. You've already marked your levels, you verify your structural liquidity, and then you're waiting for price to come and take out your structural liquidity, and then you enter. Here you don't even need any confirmation. When price gets to your level, you must enter. But I'll also be talking about some of the invalidities in that case that you don't have to take a trade. I'll be doing that on the next video. So here, this is how it is. This is exactly how you enter. And then for a downtrend, so here we have what? A high, price will form a retracement, or the structural liquidity will have a break. How do we mark our levels for entry? You mark your Fibonacci 2 from this high to where we have the structural liquidity. That's between this range, this distance in between. And then you're going to use any of these three levels in the middle for what? For entry. So here, expect price to come to any of them, and then you enter your trade. So here, this is how it is. So for a long position, let's say we enter here, our stop loss below the what? Our stop loss must be below the A level, and then our target For me, I always use 1:3 or 1:4 sometimes. So for 1:3, this is how you're actually going to get a trade. Then for a downtrend too, if you enter a short position at this point, structure, sorry, your stop loss or your latent order must be a little the high, and then take profit. Then hit profit. Okay. So now let me show you some of the examples of trade that I've taken with this. Show you some of the examples of trade that I've taken with this. So you can see on this left side we have an area of what demand. This is an example of an upwards trade or a long trade. So here price, the impulsive move, we have what the structural liquidity or the retracement. Then price formed a break of structure. It came to take the structural liquidity out, and you can see eventually we hit what TP. So first of all, let me clear this off. Sorry, we clear this off so that we can clearly identify the A level. Let's clearly identify the A level. So this is our A level, and then we mark for our entry. So this is our entry. There the 50% level, the 61.8% level, or 31 and 38.2% level. We always need to verify our structural liquidity too. So we verify our structural liquidity. We mark the Fibonacci from the low to where we have the first break of structure. So you can see, we clear this one first off. So here you can see the structural liquidity or the B level is below what? The 61.8% level and way below the 50% level. So this makes it what? A valid structural liquidity. And so you can take what? Such a trade. So here for long trade, assuming that we entered here, and then our stop loss is just below the A level, our target is 1:3. Here we eventually get more than even 1:3, so 1:5 on this one. Another example is on gold. Let's look at gold. Let's look at gold trade. Sorry, this chart just keep disappearing. Okay, so with gold, here we have what? This is our low, and this is the pattern. You can see we have the move, price form, what? Structural liquidity. The moves like this. Break of structure. Price came to take out the structural liquidity, and then a big bull to the upside. We have the move to the upside. How do we verify structural liquidity? Mark our Fibonacci 2 from this low to here. You can see it is what? On or below the 61.8% level and even way below the 50% level. Our entry level is always going to be like this. We mark our Fibonacci from the low to where we have the structural liquidity or the B level So here you can enter on what? The 38.2% level. And then the stop loss a little below what? The A level. Then we get what? A trade. Then we get our trade. So here 1:3, 1:4, any target you can get. Another example is here on gold again. So here this is also our A level. This is our A level. Let's look at it. This is our A. Price from what? A structural liquidity, a break. Price came to take out the structural liquidity, and then we have a move to the upside. Here it eventually even continuing a strong move. How do we verify? You mark your Fibonacci from the low to where we have our break. You can see it's below it, and then our entry level is like this. So either the 50% level, 61.8% level, the stop loss just below the what zone, the target even 1:3, 1:4, whatever, or how long you can even hold your trade, you can do so. Another example is on SAG USD. Please, if there's anything that you don't understand, please make sure to leave your questions in the comment section, and I'll also respond to it. Another example is on SAG USD. So here you can see it is what? In confluence with this demand area right here. And let's clearly identify our low. So that's our low. That is our low. Let's verify our structural liquidity. We mark from here to here. You can see it is a valid structural liquidity. Our entry is going to be this. And then our target 1:3, 1:4, 1:5. For a short trade, an example of a short trade or with a downwards trend. This is an example on AED card. AED card. So here we verify our structural liquidity. See, we have 1, 2, but we always aim for what? The last one. So this is valid. We mark our what? For entry level here, you can enter on a 38% level. You can either stick to what? One entry level. So in a case if you even miss a trade, it is okay. And not every day is actually for what? For trading game. Okay, so another example for a short trade is from AED JPY. You have a move to the downside, structural liquidity, you have a break of structure, price takes out the structural liquidity, and then the move continued with a cascade. So here you can see you have a sharp move to the downside. Then there are other examples on SPS 500. So for those of you who trade SPS 500, please, you can do well and then check this one out. So this is the date on Wednesday, 28th January 2026. Make sure to check this out and let me know in the comment section.